us to discuss what are the biggest challenges in the Australian lending space and how we can overcome this. Obviously, it's no surprise things are getting a bit difficult out there, so I just wanted to talk about some ways we can get things moving and also talk about some solutions we might have for you. Who is Picker Financial Solutions? What do we do? So we act as mortgage brokers. We specialise in investment lending and we're essentially the in-house mortgage brokers for Deleen Property. Team of 10 staff, so we're really growing and obviously adapting to the market conditions, which is awesome. And also we're active in property investors ourselves. So there's not too many brokers or brokerages out there that have quite large property portfolios. And obviously you can leverage our experience personally and professionally, which is what we do and we pride ourselves on. What are the challenges right now? Obviously, higher interest rates have gone up. Philip Lowe said nothing was going to happen up until 2024-25 with 2% interest rates. That all went to with obviously the inflation data, so things went up very quickly and everyone's been feeling that pain. Looks like we're at the peak at this point, which is great. Economists still get paid millions of dollars and they f it up. They can't accurately predict it, but it looks like we're at the peak at the moment, which is great. So those high interest rates obviously have reduced how much we can borrow, but also the inflation data also increased our living expenditure. So what that meant is that, our money of 100,000 before is going a lot less. 200,000, that type of income is getting less and less. On top of that as well, you've got servicing buffers. So when you go for a loan, if the interest rate was 2%, the stress test was 3%, so a total of 5% is how the bank would assess you to make your repayments. What then happened is we're past that when the rate's now at 6% and everyone who had their loans at 2% was beyond that stress test mean. Now with the rate of being 6.5%, there's a 3% buffer, so you're being assessed at like 9.5%, which is pretty rough. Some lenders have brought that down to like a 2.5% buffer, but you're still being really serviced a lot higher than what you're actually going to be repaying. So pretty rough on that side too. Also mortgage prisoners, right? So you had a lot of people who bought at the top of the market. In Sydney, there's not enough equity release because things have cooled off and then they can't refinance, they can't get away. What that kind of means is that, they're stuck with loans or there's not an option they've got out of there that's not suitable to their scenario. And they're really feeling the pressure. So we've seen a bit of that too. Probably the biggest one is the more competition, and I'll jump into some graphs pretty soon about the inflation and some data and things like that. So all you people who love statistics and analytics, I've got something good for you. But there's a lot more competition for people wanting to buy houses, and also housing becoming out of reach in some areas as well. So obviously regional areas, more capital cities and things like that, it's just getting a lot more competitive. These are some really big challenges, and we can look at the front page of the Daily Telegraph and all the housing crisis and things like that, which elements of that are true, but it's also, are we going to believe this doom and gloom and not actually take action? So all the people who thought, prices will drop post-COVID, prices will drop with the mortgage rate cliff, it just really hasn't happened. Population growth, migration and the supply and demand are the real key issues of the housing inequality. We've just hit 27 million of population, which is huge. 624,000 people, that's a lot. It's pretty much nearly doubled of what they were expecting, obviously on that average. So there's a lot more people coming to this country. And obviously post-COVID, people are reevaluating their lives, don't need to be overseas. Australia's a land of opportunity. Things are a lot cheaper than over there. Economy over here is looking good. So people are really wanting to cash in on that. This is also an element of the temporary visas as well. So that's really at an all-time high. So a lot of people are coming here, student visas, all that type of stuff. So basically we're in hot demand. A lot of people are wanting to come to Australia, and these numbers are showing there's a lot more visas being applied. 2.3 million, obviously kind of a bit above that kind of 1.5, high ones in that area as well. Again, slow down a bit through COVID, but it's really picking back up and very aggressively too. Also the foreign residential demand, again, probably weren't looking at too much buying property, people coming over. Now they've obviously got cash and they want to come in and they obviously want to be buying as well. So that demand is really skyrocketing, but also for new property as well, but the existing isn't too far behind too. So all these people are coming, they want to buy property. Now this is the biggest one. This is the one that's probably gonna kind of rattle me a little bit, right, where this problem's not gonna slow down. We've got the most net migration of millionaires in the world coming to Australia. Leaving China, India, Russia, UK, they've all got cash and they're coming in hot and they're buying the property. Obviously you've got other areas that are pretty wealthy too, like US, Canada, but for population wise, we're a lot smaller country with a lot more people. So that percentage of people coming in, splashing cash is a lot. It's only going to get worse. So obviously what that means for us is that, this is just going to get worse and worse, this problem. There's no real fix in sight unless we get a lot more dwellings and things like that as well coming in, which again is being very difficult at this point. So let's have a look at the population change. 620,000 people, just only about 300,000 dwellings, right? So we're getting way too many people and not enough houses being built at that point in time. So that's a massive disparity, and that's just really going to feed into the economic outlook and obviously these conditions for when we're buying property. Again, looks pretty grim, but also, yeah, these are kind of the completed dwellings here as well. In the thousands, 178,000 is predicted, and because of material costs, obviously prices, blowing out timeframes, construction's taking too long, we're just not going to get the supply that we need for the amount of people that are coming through. So unless immigration slows down, which I don't think it's going to, or what resources they want to put into that, we're just going to have this problem. It's just going to get wider and wider. Really what we need to do here is really look outside the box and the different options that we've got. So in summary of all those graphs, there's not enough supply, there's higher demand, there's more competition, there's more wealthier competition. So we're doing a lot of work and cash buyers are coming in, just taking our negotiations right out of our hands. And that's going to be the same for first home buyers as well, where they get all excited, bang, they're going to get chopped by a cash buyer or someone who doesn't need finance in that space. And the market's not going to play fair, right? So that's just what we've got to deal with. Less options available too. So those properties you wanted to buy for 500,000 and you wanted to wait, COVID or interest rates come down, well, that property's worth 800,000 now. So the goalposts keep getting further away. So the longer we're on the sidelines, the more we're going to be missing out. And these higher prices, yeah, they suck. They're just becoming more and more the norm. So the cards can be stacked against us, and we can believe the narrative and all that stuff. We can't really change the data, but how can we change our approach to get into the market or look at some outside the box options to get cracking? Time waits for no one. If you want to sit on the sidelines and not make a move, it's just going to get harder and harder. Anyone who bought a property 5, 10, 20 years ago, I don't think I've ever heard anyone say, I'm so glad I sold that property, because they're missing out on all the growth. The longer we sit here and go, I'm not going to do anything, the more we're just going to miss out. It's just going to get harder for you. So I really want to empower you or look at some ways of how can we get us in the market, what are the different strategies and things we can do so that we're not sitting here watching it get further out of reach. Talk to a broker. That's the first place, right? Look at these wonderful people over here. Amazing. Minzy in the front row, we got you. Really, really good team. Obviously, I'm going to be biased about it, but talking to any broker, can be us, can be whoever. We really need to have a look at what your scenario is, and I'm always one of, give me the information raw, don't care how good, how bad it is, let's just be honest about it and see what we can do for you. So what we essentially do, we send you out a form, you fill out that, and you fill out all your documents, pay slip statements, all that stuff, and then we'll tell you where you sit currently based on your numbers. But then we can also play around with scenarios too. So you might get a pay rise, you might want to change jobs, you might want to go part-time, you might be starting a business, you might want to close a credit card, all those type of things. So we can look at where you're currently at, discuss your lending options, and then also, set goals and budgets. So if we're not there yet, what can we do to put in place to get you where you need to be so you're not stuck on the sidelines? If you've already got properties, we can complete valuations for you. So if you bought something 5 years ago for 500,000, might be worth 900,000. And you think, oh wow, there's equity of a couple 100,000. Wow, let's just shortcut this and get into the market and go again, and kind of rinse and repeat that process. And then we'll also discuss those purchasing and refinance options. So how much equity are we getting, pulling 300,000 out, how much are you allocating to each property purchase? And we'll really kind of work with you to make sure that's the best option for your scenario. Probably one of the biggest things where the banks will use a HEM expenditure. So this is a baseline for your living expenditure. So if you're earning $100,000, they might say your living expense is $2,200 a month. Regardless if you're eating tuna and you take, you're not having all the bloody avocados and rice and all those type of things, when you're having your coffees from home and you're cutting all your expenses, regardless if you live on $1,000 a month, the bank has to use a minimum threshold for their assessments. So what I basically mean with that is that we don't want to be spending all of our time going, I'm going to, save $1,000 this year and I'm not going to have my coffees and I'm going to have $1,000. It's not going to do. We really need to look at how can we increase our income and get rid of some of these liabilities in order to increase how much the banks are willing to lend you. One thing to do there, credit cards and afterpay. If you've got a credit card for 15 grand, even if the balance is zero, the bank has to assess that as a $15,000 debt. You might reduce it to 2,000, 3,000, or get rid of it completely. A good thing to kind of remember is that for every $1,000 of credit limit, it's about $5,000 to $6,000 of borrowing capacity. So, if you want an extra 30 grand borrowing, get rid of that $5,000 or $6,000 credit card. HEX is a big one too. If there's a small amount, 5, 10K, maybe get rid of it. Obviously with indexation and stuff like that. But where it can obviously be an issue is when you have multiple investment properties, the banks have to calculate the HEX and it goes off your total rental income plus your income. So if you're on 100 grand, you've got 3 investment properties, 80 grand worth of income from the properties, your HEX is being assessed at 180K. So it can really blow out your servicing when you're on those higher incomes or you've got more investment properties there. And also personal loans, car loans, afterpay, all that type of stuff. Again, these are depreciating assets. They're not kind of asset building. And it's, that bad debt that we kind of want to get rid of here and focus on the good debt. So employment types can also be one thing too. When you're full-time, you're being assessed at 100% of your wage. If you're on 90,000 full-time, banks use 90,000. If you're part-time, they can, obviously play around with that, but again, if it's part-time, 45,000, they'll use that. Casual, generally speaking, most lenders need 6 months worth of that, and then also may shade that by 80%. So if you do change from, say, casual to full-time, or you change a role in that, it can really increase that borrowing capacity. And also self-employed and starting a business. So generally when you're self-employed, you used to need to kind of have 2 years of financials. You can change from being a sole trader to a company structure, but basically we need 2 years financials, and unfortunately looking in the rearview mirror most of the time on your previous experience. However, there are some lenders now that are doing salary credits if you're doing it over 6 months in a consistent wage, or we've got lenders that can use 1 year's financials. So if you were affected by COVID and you think, oh, it's no good, there's actually lenders out there that can look into this as well. So really what we want to focus on, and this is what our role is how can we increase your income to get you further into the market, and what can we get rid of to make those numbers look as strong as possible. And again, I know it is easier said than done in some instances, but this is where we have these conversations of what can we do in order to get you to that next step. First home buyers, and again, these are the things that people might not be aware of. If you're a first home buyer, basically if you've never owned a property at all and you want to buy a property to live in New South Wales, basically no stamp duty, sub 800K, and no lender's mortgage insurance, sub 800K. Outskirts of Sydney, you might find something pretty decent, but if you're going to buy something in Sydney for 1.5, 2 million, sorry, no dice. It is kind of more towards those budget properties, but is that going to be suitable for your family? Are you going to live there for the next 10, 15 years? Or are you buying a piece of property to get a tax concession and pay no LMI, and that property's not going to do you any good in the future? So that's one thing we really need to make sure it's worthwhile. Now, if we don't qualify for that, or you've owned a property before or whatever, guarantor. Guarantor to me is like the 8th wonder of the world, like it's the best, right? So if your parents got a property for $1 million and they owe $100,000 on it or whatever, you want to buy a property for $800,000, we just need to get a 20% guarantee from their property. So no cash actually changes hands, but if you bought that property for $800,000, you would have a full loan for $800,000, just 20% of that is secured by your parents' property. And the ultimate aim is that, we're going to have no lender's mortgage insurance, but also no deposit needed there too. And some lenders can even allow you to put the stamp duty on top, which is amazing, depending on where you qualify on that. But you could literally get in and just pay your solicitor's fees, and that's awesome. So that's one way to get into the market. Obviously, if we're doing new builds, yes, there are the 10K grants, but I'm not a massive fan of new builds. Obviously, you've got to look at build quality, how much is the developer getting a kickback, how long is it going to take, what's the workmanship like, etc. Existing properties, you know right away that you can jump in and you know exactly what you're doing with those pest and building reports and all that type of stuff. So not a huge one on that, but could be an option. The other one is your second and third tier lenders as well. If CommBank says no, NAB, ANZ, whoever says no, we've got options outside of this who might be more favourable to your scenario. If you've got investment properties, if you've got a certain type of income, if we need to use 100% of casual or 100% allowances and not have it shaded, there's some really good things there too. But also those third tier lenders like your Peppers and Liberty, right? If you think your credit score's no good or you had some issues previously, you can speak to Zarko at the back, he can sort you out as well from Credit Fix Solutions. So we can look at these options of, okay, do we pay a higher risk fee in order to get into the property, have good history for 12 months? These guys will charge you a higher interest rate, but we can come back and refinance it later, so we're not here forever. Or what can we do to fix up that credit score? So again, rather than walking into CommBank and getting declined and going, oh, no good, talk to us. We've got 30, 40 different lenders and options, and this is what we really focus on. Simplified self-employed as well. So as I was saying, you can show the salary credits now. If you've started a business recently, it's on an upward trajectory. We can look in the front end of the business, not so much in the rearview mirror, which is really, really good. And also your alt doc lending too. So if we're not quite meeting any of those criteria, business is going well, you get on well with your accountant, they can project that things are going well, we can look at that too. But the really big thing here, especially in the Sydney market, is are you just buying this to get a stamp duty concession or whatever, and is it actually worth it? Or are you better to look at buying an investment in Perth for 400K, which is more likely to double and pay a bit of stamp duty or whatever, right? That's what we look at for first home buyers. But we do specialise in this, and we've got a lot of really good information on this too. So if you need it, please let me know. I'm happy to send it through to you. Because we get the good stuff, investors. Really, this is what we primarily focus on. And again, looking at that data too, with the housing market being out of reach in certain areas, looking to go down the investment option or rent vesting is becoming a lot more popular. Term rent vesting is rent where you want to live, invest where you can afford. You want to live at home rent free, you want to live in a share house in Bondi, pay $300, you want to live wherever it is in the world, doesn't matter, but you can still have your money work for you. Rather than buying a home for $2 million, you can get $2 million in property and still get that flexibility that you need towards your goals. And again, it comes back to that goal and that starting point too. There's no schemes, unfortunately, for investors. You've got to cop a little bit of it here, but obviously the end result and that profit and what the equity that you're aiming for is what you really want to get. ANZ, 5% deposit, and you can chuck your LMI on top for a total lend of 97%. It is expensive, but if you've got bugger all cash and you really want to get into it, we don't have to be here forever. We do the 5% deposit, might cost you 30, 40 grand, maybe 25, depending on how much it is. You get into the market, and then we can refinance it in a few years' time when that property's gone up in value. A really, really good way to get in going, oh, I've got to save 100 grand. No, you can get in for a lot cheaper than that. Guarantor, again, you can do that for investment properties too. So again, if your parents, some banks may let you do other family members, but probably parents is probably the way to go. No deposit, no lender's mortgage insurance, and you can add the stamp duty in with some lenders, but not all. So again, you might be able to purchase an investment property. If we buy it for 400,000, have it for 2 years, maybe it's worth 550, 600, then we unsecuritise mum and dad. You got that property, it's on its own 2 feet, and you're using the power of leverage to get in to build your wealth base. And this is really, really important and a really good way to do that too. Again, that's simplified self-employed for that verification. If business is going well, we can use that for investors. The second and third tier lenders, as I said as well. And one thing too is that when you have, say, 4 or 5 investment properties, most of the big boys, CommBank, NAB, etc., they will use 80% of the rental income that you get, and then they also have an investment property holding cost. So let's say that's $400 a month. You've got 5 investment properties. I'm shading your rent to 80%, and then I've got a $400 a month holding cost. So if I've got 5 properties, there's $2,000 that's being smashed out of my servicing. I've got lenders in the second tier space that don't have that investment property holding cost. So when CommBank says no, First Mac might give you another 400 or 500K. All right, so there's things like that, the negative gearing assessment rates, living at home rent free. There's all these other things we can get letters and do certain things to try and stretch it as far as possible, obviously as long as it's in line with your scenario and is accurate and correct, and that's where the second and third tier lenders can really come through. And we don't have to be here forever. You get your 6th or 5th investment property with these guys, then we have a change in scenario. If interest rates come down, whatever it is, we can always try and refinance back to the big boys later, but it's not always about the interest rate. It's who's going to give you the money to make that money and that equity for you, okay? Self-managed super fund, really, really big one at the moment. It's in conversation. I seem to be speaking to so many people about it here today. Self-managed super fund, you can use a superannuation to purchase investment properties. You cannot use it for owner-occupied purchases, but you can use it for investing. A couple of things, probably costs about 5 grand to get set up. You need an accountant to do it. They obviously audit your financials, all that type of stuff. It's a bit of a pain in the to get going, but once you've got it, it's also a bit of a pain to sign your loan documents and stuff as well. But it's a really, really good way to get into the market. You need to do a 20% deposit minimum. There's also a lot of regulations that it has to be investors. You can't have your family or friends kind of living in there. And the interest rates are a bit more expensive, but I generally say maybe around 80, 90, 100K is a good starting point to get in there. Obviously the more the better, and we do a fair bit of that too. You've got alt doc lending, again, letter from your accountant saying, hey, this person's business is going well, they can afford X, and that can also really work for investment properties too. If we're tapping out with the second and third tier lenders and they're not seeing your business for where it's going, it's a really good product to look into. And the main thing is you're retaining that capital growth. So if you're negative 20 bucks a week, but this property has made you 100 grand, 200 grand, 500 grand, that's really where your wealth is going to be made in property investing. You've got an asset to leverage from. So in my property portfolio, I've got 18 properties. I've just recently purchased my big owner occupied probably about 6 months ago, and I pulled all my equity from 5 properties to get the stamp duty, did a 20% deposit, all that type of stuff. So you're using it later on. You're kind of building up to make a big play. And if you've got a portfolio of 5, 10, 15, however many properties, when it comes later on down the piece, you're going to have that asset to get you into that, whether it's a business decision, buying a commercial space, whatever it is, owner occupied, all that type of stuff. And the tax deductibility as well. So again, I'm not an accountant, but basically hold on to all your invoices, your receipts, anything you pay towards an investment property can be considered as something you could have as tax deductible. So investing is really, really good. If you do want to look at building that wealth, obviously takes a little bit longer, but is a really effective avenue. Now, I don't want you to miss the boat, and I'm sorry I shouldn't swear, but honestly, we've got to get in there and make it happen, because the longer we leave it, you've got more people coming here from overseas. Obviously the competition's getting harder. We can just buy into the narrative and miss it. The amount of times that Eddie said, hey Justin, you should buy this property, you should buy this property, you should buy this property, I didn't do it. And I'm her, I've been there so many times. And even Eddie would have the same thing as well, there's been so many opportunities missed, and you just don't want to pass that up. And again, if you look at your parents' properties, whoever said, they've all increased in value over time. oh, we wish we didn't sell that property in Paddington and when it for 150 grand, or I bought a convertible instead of doing that, or all those type of things. I think that's you missed out on that opportunity. So with the data that we're seeing, it's only going to get worse. So we've got to make sure that we're in the hunt for making it happen. So let's chat. Let's make it happen. Phone, email, text. You can scan this. It books to my calendar. Happy to have a chat. See what we do. Let's have a look at the information raw and get you moving in the right direction towards your goals. So thank you so much for your time. I do appreciate it. Yeah, so that's that. Are there any questions?
Sorry, how much the, like when you do the assessment, how
Yep.
much the government earners, for the loan, they calculate that for expenses for individual family?
Yep. Yep, so if you are single, you might be, say, 1,500. If you've got kids, if you're married with 2 kids, 4 kids, some lenders, if they can see vet bills, they'll declare an animal as a dependent as well. So it varies from lender to lender. Also, it varies on your scenario too. So there's a benchmark that will be there, and when we review numbers, we can see that. But again, if you've got dependents who are over 18 and stuff like that, that are working and they're not a dependent now, we can have a look at it. But there's really not much movement on that baseline based on your scenario. Yeah, but it obviously covers you things like your living expenditure and all that type of jazz. Eddie.
What kind of fees are associated with going from like a 3rd-tier lender to a 2nd-tier lender?
Yep, cool. So yeah, so a standard refinancing costs probably about $600 to $700 if you went from, say, one of the majors to wherever. Discharge fees usually about $300 to $400, and then you've got to deregister and re-register the mortgage, so that's about $125 each side. But when you're going with some of those other ones like La Trobe and things like that, they might pass on their legal costs and things like that. So it can be maybe $1,000 or $2,000, maybe a little bit more depending if you've got early fees and break fees. But generally speaking, it shouldn't be too much, but only really refinancing if we need to. But if we did get a loan with a 3rd-tier lender, you buy a property for $700, we're refinancing when it's worth $1 million, we can pay those exit fees just the cost of doing business. So again, we can look at that. And when we do look at each lender scenario and know the strategy, okay, we're going to refinance in 2 years, I'd be saying, okay, just bear in mind that this is the fee, or can we go with this lender, it's a bit cheaper. It might be a bit more expensive, or there's a fee here, but there's a big discharge. So yeah, we basically look at those options and present them to you. Amazing. Well, I really appreciate you staying to the end. I'm keen for a beer. Let's make it happen. Thank you.